So after we have a cash flow before working capital changes, now we can talk about working capital changes. We can talk about working capital changes. So we can talk about working capital changes. So under working capital changes, remember that you consider current assets and current liabilities, but not all the current assets, assets. So under current assets, you consider items like inventory, that is increase or decrease, and we have trade receivables, increase or decrease. Then maybe if there's prepayment, you consider that increase or decrease. Then when you go to the current liabilities, you consider items like trade payables, increase or decrease, and decrease. So we can go to our question so that we can check those working capital items. So the changes, the increase or decrease in those items, the increase or the decrease. So go to your current assets. So your current assets, you can see we have inventory. Did the inventory increase or it decreased? So remember that we consider from 2012 to 2013. At the start of this to the end. So it increased, eh? So that is an increase. By which figure?
$960.
So that is an increase by 960. So that is an increase by 960. Because you will take the difference. You will take the difference. Then another item which is there. So because you will take, like now, inventory it increased from 1880 to 2840. So when inventory increases, it means that you have bought stock, you have bought assets, which means that that is a cash outflow. That is a cash outflow. So cash outflow, you subtract. So this is a cash outflow. Then what about receivables? So I can see we have receivables there, debtors. So again, it increased. So it increased by which figure?
They decreased.
It increased or decreased?
620.
It increased.
They increased by 620.
So increase in that by 620. So that is a 620. So increase. So right here, increase in receivable. So remember that when your debtors increases, it means again you have given them money. So you are giving money out to your debtors. So you have said which figure? 620.
620.
So that is fine. So that is cash outflow. Your debtors have increased. So there is money out. You are rendering more money to your debtors. So another item.
Cash.
So cash, you cannot consider cash.
Cash you don't.
So why? Why?
Yeah,
Why am I not considering cash?
I don't know if it's the right explanation. I think cash is that's the whole purpose of the cash flow. At the bottom, yes, I think that's the reason we don't consider cash. I can't explain, but I think that's the reason.
So this is all about what our main purpose is, because we will consider the cash we have at the start, then we check operations during the year, so that we can see if it's tallying with what we have in hand of 140 at the end of the year. So this is one of the cash and cash equivalent item. So you have not to consider, because this is all about the own purpose of the cash flow statement. So the cash you have at the start and the cash you have at the end after operations during the year, is this figure tallying? So that is why we cannot consider this under working capital as a working capital item. So that is all about a cash and a cash equivalent item. So we go to the current liabilities. So current liabilities, you can see we have again bank overdraft. So again, we cannot consider bank overdraft. Bank overdraft is also a cash and a cash equivalent item, because once you have cash, obviously you have to pay your overdraft immediately. So these are among the cash and cash equivalent item. So on this scenario now, I have to consider accounts payable. So I have to consider this payable. It increased or it decreased? It increased, eh? By which figure? 290. Yes. So increase in payables. So I'll write here and say increase in payables. So the increase in payables, that is 290. So what about that? Is there cash inflow or outflow? When your creditor increases, who is your creditor? Someone
cash inflow, because you haven't given out cash.
Yes, so you put on credit. Eh? So they are increasing because you have not given any cash out. There's no cash out. When your creditors are increasing, it means that you owe them money, but you have not paid them. So there's no cash out from. So then what's another item which is remaining? Another item. So for the account accrued loan interest, that is a financing item. Even dividends payable, we will consider it under financing. Then for tax, after my answer here, after considering the working capital items, I have to subtract tax, of which I have to consider both deferred and current. So up to this point, you can give me the answer. Up to this point. So the cash generated from operations. Cash generated from operations.
$1,550.
That is. So someone has said 1,550. Eh?
1,550. Yeah.
Then we have to raise tax. We have to raise tax paid, of which we need to consider. Under tax, you consider both deferred tax and you consider current tax. So that is why I have to do my working number one. I have to do working number one. So working number one is concerning taxation. So I have to consider current tax and I have to consider deferred tax. So remember, the current tax is the tax which is applicable in the current year under consideration. The corporation tax. So deferred tax also is provision for future tax in the current year. Deferred tax is all about provision for future taxes. That is why you find that deferred tax is a long-term liability, because it's all about provisions you have made for your future taxes. Then current is what you paid in the current year. So you have to consider both of them. So you have to check your deferred tax under non-current liability and your current tax under current liabilities. Under your current liability. So let's go to that point. So you can see we have deferred tax. Deferred tax, at the start, you have to take this to 80. Then what about current? 320. So you have to combine the two. So 280 plus 320. 280 plus 320. So that is balance brought down. So you say 280 plus 320. So what are you getting there? 600? So after that, you have to consider the tax paid for the year. So the current tax. Current tax from P&L. So the current tax from P&L. So the one which is in the income statement. Go to your income statement. So this one. So there's a current tax here. This one of 540.
7. Yeah,
It's 540.
Yeah.
Yes, it's 540 there. So the income tax expense from the income statement, this one, the 540 you add. So after that, so 600 plus 540, that is?
1140.
That is 11,440. Then skip one line, you skip one line here. Then you say balance carry down. The balance carry. So balance carry down, you add again the two. That is current tax and the deferred tax. So the balance carry down for current and deferred. So for deferred is 620. And so we have this 620 and we have a current of 260. So 620 plus 260. 620 plus 260. That is
880.
that is 880. So you can see your tax reduced. So after starting with 600, then they paid for the year a tax of 540. We have 1140, but at the end the tax is 880. So which means and it reduced because they paid tax. So tax paid off. So 1140 minus 880. So they paid a tax of
260. 260.
260. So that is fine. So that is what you need to subtract here as your tax paid. That is what you subtract there. So 1550 minus 260. So that is now what you get as cash flow. Cash flow from operating activities. Cash flow from operating activities. So you put on the second column 1290.
Yes.
So that is 1290. So this is your A. So you are done with operating. So we move on to the investing. So before I move to investing, any question? Any question concerning this operating? So which means that silence is consent. So we can move to the next part. So we move to the next part, which is investing. So it's a continuation. So it will be a continuation. So investing. So let's talk about investing activities. So under investing activities, you consider around 4 items. Under section 6 is where we consider around 5 items. But at your level, you consider around 4 items. Which are these items? So on this scenario, you consider what you received when you disposed an asset. So cash received on disposal of an asset. Then you consider cash paid if you acquired an asset. So you say cash paid on acquisition of an asset. So I've said if you disposed, you received cash. So you say cash received on disposal of an asset. If you acquired, you paid cash. Cash paid on acquisition of an asset. So those are the first two. And another asset which is maybe intangible or tangible. Another asset may be acquired or disposed, you consider it here. So after you have considered what you received or what you paid on acquisition or disposal of asset, you again consider investment income. And after investment income, you consider dividends received. Dividends can be received either from an associate or a joint venture. So in order to know if it's an associate or a joint venture, you go to your non-current assets. You check what investment you are given there. Like now in this question, if we go to our non-current assets, we can be able to determine where we received our dividends from. Was it an associate or a joint venture? So you can see like now here under non-current assets, you are told that the investment is from which company? The investment which this Uongozi made is in the associate. So which means that they will receive dividends from the associate. This is what will guide us. So I've said you consider 4 items: cash received on a disposal of assets, cash paid on acquisition of an asset, investment income, and the dividend received, data from an associate or a joint venture, of which in order to know if it's an associate or a joint venture, you check on your non-current assets to see which type of investment this organization made. Was it in the associate or a joint venture? So we can go direct and check cash received from disposal of an asset, which was there in note 1. Which was there in note 1. But in note 1, it's not a direct amount you are given which they received, but you are told that they made a loss of 100. But now in real sense, in order to make a loss of 100, at what amount did you sell? So we sold at what amount, then we made a loss of 100, so that we will be able to determine what we realized. So we have to determine at what amount did we sell this plant, which was done once, at what amount which we made a loss of 100. So what we will do in order to determine the disposal value, we have to do our PPA analysis. So right working, it's working too. So you have to do your PPE analysis here. So someone mute, there's a background noise. So BP analysis, you write your balance product. So record your value of property, plant, and equipment as of 2012. So as of 2012, the property, plant, and equipment was, so this one was 3660. So this one, so 3660. So that is the brought down. That is the balance brought down, which I have to record there, 3660. Then before I compare with my balance carried down, I have to consider anything affecting property, plant, and equipment. And you know that property, plant, and equipment, it concerns tangible assets which have been aggregated together and named as property, plant, and equipment. So you have to check anything from the first additional information to the last, which is affecting a long-term tangible asset, so that we can be able to adjust against 3660. So let's go to additional information number 1. So your additional information number 1, that one, they say cost of sales include depreciation on property, plant, and equipment. So it contains a depreciation of 640. So remember that depreciation is all about property, plant, and equipment, which is depreciated, which is a fixed asset. So we have to raise. So the 640. Then after that, we move next to the next additional information. So additional information number 2, they talked about intangible assets. And you know that intangible assets cannot affect your property, plant, and equipment, because I said property, plant, and equipment concerns tangible fixed assets, long term, that is. So number 3, during the year, and that is 30th September 2013, holding company acquired a new plant which cost 500. So there's a new plant which was acquired. So we have to record acquisition of new plant. And also we have to record there, they say the company revalued its building by 400. So you have to record the acquisition of 500 of a plant and the revaluation of building. So both two of those assets affect your PPE. They are tangible long-term fixed assets. So you have to record about the acquisition. So acquisition of that plant, 500. So this one increases this value. Then again, they talked about revaluation again. So there was a revaluation of building. So revaluation was 400. So after that, we need to check if there's anything which is remaining, which is affecting our property, plant, and equipment. Note 4 was concerning bonus issue. That one was concerning bonus issue. The note 5 was an analysis concerning retained profit. So note 5 was analysis concerning retained profit. So which means that up to that point we are done. So you say your answer there is, so 3660, you minus 640. You add your 500, you add your 400. So you are getting 39, 20.
39, 20.
Then you skip one line, then you say balance carry down. Skip one line, say balance carry down. So balance carry down, that is a figure for 2013. So the figure for 2013 was concerning this property, plant, and equipment. So this 3780. This one. This 3780. So we can see that our figure after all adjustment, it was 3920, but at the end is 3780, which means that it has reduced. Why? We made a disposal. So if it could have increased, we could have said we made an acquisition. But if it reduces, you say that you have made a disposal of a fixed asset. So you disposed by what value?
140.
So 140. So this is the disposal value. But when we disposed at 140, we made a loss of? So that is why they said note 1. Cost of sales include depreciation on property, plant, and equipment amounting to 640, and a loss on sale of plant of 100. So which means that when we sold this fixed asset at 140, we made a loss of 100, which means that we realized how much? The cash we received is?
40.
That is 40. So you say cash received on disposal of assets. So cash received on disposal of assets, that is 40. So that is a cash inflow. So after that, remember that you have to consider cash paid. Cash paid on acquisition of assets. On acquisition of assets. So I think we acquired an asset. It was direct in the question. There's an asset we acquired at what value?
500.
It was 500. That is under note 4, note 3, not 4, note 3. Note 3, they say during the year ended 30 September 2013, holding company acquired a new plant, which cost 500. So that is what we need to record there. So the 500. So cash paid, remember that is cash outflow. We subtract. Again, according to note 2, there is another thing we acquired, which is not a fixed asset, but an intangible. So this one. The one which was acquired. Other intangible assets acquired during the year amounted to 1,000. So you have to say cash paid on acquisition of other intangible assets. So cash paid on acquisition of other intangible assets. So that is 1,000. Then after that, I said we consider investment income, but it was not there. Remember that if it was there, we consider it here, and we consider it under your adjustments, under the operating activities. So, but it was not there.
Question. Sorry.
Yes.
Sorry, a question. Investment in associate company. That's not an investment.
So there's an investment
The
income.
investment in associate company. What's the difference with, investment income is income that the business has received. Sorry. And this is an investment in associate company. That's why I'm being.
So that's fine. I see you are a good student. You ask a question, then you answer yourself. So anyway, so the next thing we move to is what you have said. Investment in associates, of which I said we check under the income, under the non-current assets. So under your non-current assets, check that. So under your non-current assets, investment in associates. So investment in associates at the start it was 160. So that is what you consider there, 160. So investment in associates. So that one we will be able to. So this one will assist us Samsung to determine a dividend received, which is an income. So investment in associates.
Okay.
So this one will assist us to determine the dividend received. So balance brought down is 160. But I think I have said that. It was 160. Yes. So that is 160. Then you add the profit they received during the year. Profit from associate. What they remember their investment at the start was 160. Then profit from associate during the year. During the year. So this one is from P&L. So what they received during the year was from your P&L, from your balance sheet, not balance sheet, but income statement. So this one, group share of associate profit after tax. So this 40, so that is what they received as an income from that associate. So you add that. So the 40. So if you take 160 plus 40, that is 200. So skip one line, say balance carry down. So your balance carry down was
190.
Balance carry down is 190. So which means that your investment, you started with an investment of 160. Then you received an income during the year from that associate where you invested of 40. So by that time, your investment is a total of 200. But at the end, you can see it's 190. Why is the investment reducing to 190? Because you received 10 during the year as dividend. So dividend received. So 200 minus 190. So you come here and record dividend received. So dividend received from associate. of 10. So that is a cash inflow. That is a cash inflow. So your answer there is, that is all about investing. So 40 plus minus 500, not plus, minus 500 minus 1,000 plus 10. So cash flow from investing,
Negative 1450.
so we say that that is a cash outflow. So no, so that is the way you are supposed to mention that. Cash outflow of 1140. So that is fine. We move to operating activities. So remember that operating activities is what the items you consider items which finances your organization. So how can you finance your organization? Through which items? What items can finance your organization?
Loans.
Loans, and so you have an issue of shares and so on. So that is why I have to consider my items under equity and some liabilities. So go to your equity part. So mute your microphone. So we have equities and liabilities. So my first item to consider there is all about. So I would be considering this. So those are some of the financing items. Then I have to consider even liabilities. So debentures, I have to consider bank loan. So I don't have to consider deferred tax because that one has already been considered. We have subtracted that. We combined with current, we subtracted up there and operating activities. So I have to consider these items under equity, 10% debenture, bank loan, and the only thing which is under current, which I have to consider is interest, this one. So we can start from ordinary share capital, which we combine it. We combine my ordinary share capital with share premium. So we consider that. So let's say, so this is another working. So ordinary share capital and the share premium. So that one you combine. So balance production. So the balance production there is, so this one is the two of these. So which means that 1,000 plus 200, that is 1,200. Then after that, you need to consider anything affecting your capital before we compare it with my balances carried down. So remember there was a bonus issue which was made, and you know that the bonus issue is whereby the company makes an issue of shares to the existing shareholders for free. That is for no consideration. So that one will increase your ordinary shares. So we need to consider how it was done. In which proportion did they make a bonus issue? So this bonus was made in which way? On 1st October 2012, the holding company made a bonus of 1 share for every 10 held. So for every 10 held, you were given 1 for free. On which date? 1st October 2012. So how many shares were there as of 2012? 1st October. So you go to your, remember 2012, the value we have here is 1,000. So which means that in order to get the shares, we divide with 10. So what I will do here is all about bonus. So bonus was 1 for every 10 held. How many shares were held? It's 100. Because I have taken 1,000 divided by 10. That is according to how we are told as at 2012. So we will say how many shares were given through bonus. So you take 1,000, not 1,000, but 100 times 1 over 10. So I'm getting what? I'm getting 10. So those are 10 shares which were made through bonus issue. So in order to get the total value there, you multiply with shillings 10 per share, so that we know the value of the 10 shares which were through bonus. So that is 100. So that is what we need to add here. So we need to add the bonus issue of 100. So that is 13. Then we compare with balance carried down. So my balance carried down was, so you take 1,500 plus 700. 1,500 plus 700, this one. So 1,500 plus 700 is, so that is 22. So you can see it increased from 13 to 22, which means that they received more cash by the end of the period. So that is all about they received because they issued shares. So issue of shares. So which I will take 2,200 minus 1,300. So that is 9. So that is cash received because it increased. So you say cash received